Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, and also have Joseph Clark, our Managing Partner and Certified Financial Planner. Thank you, Joe, for joining us again and covering this Market Carver for June the 9th, 2022. So we crossed a critical milestone. Zach, our newest member of the allocation team that joined us a couple years ago, did the honor of leading this week's investment meeting. So it was truly wonderful to see the great job he did of doing some great analysis and turning from somebody that's been a research fellow to really doing his own analysis and helping cover the investment meeting. So some of this stuff is going to be sourced from Zach, and I look forward to hitting it. And for you, Joe, I mean, we've got a couple topics. I'll certainly have you start off on the sectors. That's the first piece of what we're going to talk about. Then we're going to look at the technicals, the S&P 500 trends. I'll fill in for Andrew doing a little bit of technical analysis. And then we're going to cover 6-month returns and kind of check that notion of there's always a bull market somewhere or not. And then lastly, for earnings. So, Joe, we've got a couple slides here on sectors not being equal. I think a very important piece of any market cycle.
Yeah, I think one of the things that you need to remember when you're watching the Market Carver, just by definition that you're here, you have a better understanding, most likely, of what's going on inside of the market than your neighbor. And I still contend that over half of the people outside of listening to large financial broadcasts, including those that listen to CNBC, don't understand that the S&P 500 is actually made up of 500 companies that are not equally weighted. Remember, they're market cap weighted by one share of a company's stock times the current share price times the number of outstanding shares. It's made up of 10 or 11 sectors, depending on how you look at the S&P 500 now when we added real estate. But the percentages are not equal either, right? So you will hear people talk about, going back to the tech wreck in 2000, the S&P 500 taking years to make a new high. That was true, but it's because technology and telecommunications were such large subsectors. So if we look at this pie chart going back to December 31st, going into the year, you can look at that light blue. That's information technology. A full third, 29.2% of the S&P 500 were just the technology stocks. And believe it or not, Amazon's not even one of those. That's in consumer discretionary. So you've got over half of the pie made up of three colors: consumer discretionary, healthcare, and information technology. The financials are the brown. And what you tend to see is an oscillation between the financials and the other. Now, anybody who's been at the driving down the road has heard people talk about energy prices. Adam will remind you that prices don't necessarily translate to earnings, but they certainly have translated to stock appreciation. But look on this chart, if you look at the energy sector, clearly the best performing sector, it was 2.7% of the entire S&P 500 at the end of last year. Now, if you'll put up the next slide, we can see where it is at the end of May. Energy, with all of its appreciation. So you've got two things at work, right? You've got the appreciation of the energy sector actually in positive territory, and the depreciation of the rest of the sectors going down, but it's still only 4.8% of the entire S&P 500. And so one of the things that Adam and Andrew are great at doing with our risk barometer and everything else is not just looking at the marketplace, but understanding which sectors have the greatest strength relative to the rest of the marketplace that's going forward. So that's just really what I wanted to remind you on the sector, so you understood where we were and what was going on.
Yeah, and so important to what we do here, and as it always works out, we're often asked, is it time to look at this beaten down sector or that beaten down sector, and we certainly had that about energy in 2016, in 2017. We don't have to have the actual bottom. We're more interested in finding an area that's really depressed like that, and then really starts to show momentum, because they can have a long way to go. And appears to be the case for energy right now. Won't last forever. Of all the cyclical industries, that one sure takes the cake for being cyclical. But right now, that is certainly one of the areas we're heavily focused on for the time being. So we want to take an update now. I think it's very important to stay hyper focused on the trends of the market because we're at that point where each and every moment is scrutinized, and we're looking at the S&P 500. This is a chart of each day's price action. Each little bar represents one day of action, and the critical formation here. What's happening is if you look at March in there for 2022, we had the invasion of Ukraine that really set off one of the sell-offs this year, but eventually the market found some footing and it went back up. So that level is what we found as support. That is where buyers came in to support the price of the S&P 500. We've had some action since then. We've had a rebound. We've had another fall down. And now we have finally a subsequent rally here over the past couple of weeks. But we're finding a very important level that was previously the support. That is a very important dynamic. One of two things are going to happen. That support turns into resistance, which is certainly the case so far, or we break through it, and that would add a lot of confidence to the market. So we're at a very critical juncture. Seem to say that a lot, but that is certainly the case as we form new trends in the S&P 500. So very, very important price action here in the very near term. Turning our attention now and just looking at some asset classes. I know we've shared several of these types of data points for this year, but so this really highlights to me how important or how hard diversification is. I understand it's a little fuzzy to see all of those, but it's showing you over 10 different asset classes, different types of stocks, different types of bonds, commodities, all thrown together there. And what we're looking at is what is the best of all of those things happening at any given point. And if you think about it, if you look at just simply the best, all right, that's an overly optimistic or an overly rosy way of thinking about it. But you should always find something that's doing well. Even a very bearish environment like 2008, you had U.S. Treasury bonds and a few other things doing well. What do we find here? The best of all of those is actually down 9%. So this is not, the best way to look at a diversified portfolio, but instead showing you what the opportunity set is out there. And that opportunity set has just not been great, as we know, the stocks and bonds going down together here. So that 11, this is just over the past 6 months. One final thing to share here, and I know it sounds like we have shared a lot of bearish news, but I think that's just under the premise that we will always share with you what we are seeing. And this is one of the things right now that's happening. The first part of this year was all about, if you look at the downturn in the S&P 500, the price to earnings relationship coming down. At any point in time, the price of the S&P 500 or Dow or any index is a component of two different things. What is the earnings of the underlying companies? What is their profit levels? And then how much are investors paying per dollar of earnings on those? And what we've seen so far this year is earnings have held up. They've been okay. It's the price investors are willing to pay for those. So the concern from here is if we see earnings deteriorate, and if we do head into a further economic slowdown, that's likely to happen. So for over the past 75 days, the trend, not just in the United States, but across the globe, has been for a revision down in the earnings. So that is weighing on stock prices right now and turning that support level into resistance. Hopefully, sometimes that can create a good phenomenon during earnings season where those revisions down creates an easy bar for companies to beat. Hopefully, that is the case as we get into July. But so far, the trend is not our friend in terms of earnings revision, and that is one of the next levels of concern, having seen the price to earnings ratio come down a little bit. So, Joe, I know this has been a quick hit and a lot of different topics. Is there anything else you'd like to fill in here before we round out and close out for the week?
Sure. Just on human nature, and let's think about going to confession. Right now, I'm not, I don't practice the Catholic faith, but I certainly understand sitting in the confessional. Once you're in there, you might as well get as much out as you possibly can. The same is true when you're sitting there, when your neighbor's confessing as well. It's just easier. You're all there together. Something that did not come out of the pandemic because it was so shocking and so quick in terms of a market going down and a market rebound is you didn't have CEOs confessing all of their sins on their balance sheet and getting out all of the bad things in their business because it was so quick and people were so uncertain. If they did anything, they tried to talk the market back up or their companies back up. What typically happens when you see earnings revisions like this, the neighbors throwing the baby out with the bathwater, they're already in confession, you're there too. And what you're going to see in what I believe we are seeing is truly earnings that have contracted and the revisions come down. But I think you're also hearing people get rid of anything out there that could possibly be a problem in the future. While you're hearing bad news, you might as well hear all of the bad news. And we've seen that trend over our entire careers. I think that that's there, and kind of listen for extra bad news, I guess, when people are given those earnings revisions. But we are in very, very interesting times, undoubtedly. And Adam really summed it up at the beginning. You know, you've got support and resistance, and every week seems to be an important battle line. And that's really what markets do. You battle back and forth until that line is broken. You don't know which way it's going to go, but it is our job to watch it for you. And that's what we're doing.
Yeah, absolutely. Couldn't have said it better myself, as I would expect. So appreciate you, Joe, and the time that you've given us this week. And I appreciate all of you for giving us a few minutes of your time to cover things that we found important from this week's investment meeting. As always, don't forget, you can give us a call to schedule your meeting or scan this QR code, whichever is more convenient for you. And don't forget that we do have a weekly radio show over the traditional airwaves on WIBC and a few other programs around the state. Or through podcast, however you get yours, which may be the most convenient for most of you. So thanks again, and everybody have a great weekend.